Would you be interested in a company that's trading at a historical huge discount and trading at the best PE ratio in 18 years, and they are using $1 billion every month on buying back its own stock? Then I have amazing news for you. Comcast is down 37% over the last year, but have amazing fundamentals. They took a big hit end of July, dropping around 15% after the earnings call. An earnings call that was actually very positive, where Comcast beat the expectations both on top line and bottom line, but for the first time ever they lost broadband subscribers. Something that analysts have been expecting for several years, so I was quite surprised to see that drop. With that said, let's take a closer look at Comcast. As you can see here, they are trading at a forward non-GAAP PE ratio of 10.45 compared to the 5-year average of 15.65, at 33% below the 5-year average. And if we come down to the price to book, you can see here that it's trading at 1.78 compared to 2.38, which is 25% the 5-year average, so that is looking really good. It offers a 2.87 dividend yield, and that's a payout ratio of just below 30%, which is looking really nice. The 5-year average growth rate is 12%, and they have been growing the dividend for 4 consecutive years. If we look at the numbers behind, you can see here in the income statement that the revenue have grown from $85 billion in 2017 to $116 billion in 2021, and also growing over the last 12 months. And if we come down to the net income, you can see here that it's been a bit spotty, but we had a very good year in 2017, and after that it's 11, 13, 10.5, 14 and 14, so they still have pretty decent net income, I would say. Looking at the cash flow statement to see that free cash flow, you can see here that the capital expenditures are pretty fixed: 9.6, 10.2, 11, 10.6, 10.1, 9.8, and the cash from operations are growing: 21 billion, 24, 25, 24, 29, 27. So they are generating a massive amount of cash. Jumping into the balance sheet, you can see here that they have $6.8 billion in cash on hand. But if you scroll down here, you can see that there is a massive amount of debt. Right now, over the last 12 months, they have $98 billion, but they have been reducing it from $111 billion to 107 to 98. So they are paying back with all that cash flow they're generating. And as you can see here, like I mentioned in the start, they are buying back a lot of their shares. They went from 4.6 billion shares outstanding to 4.4, a massive reduction, I would say. That was how some of the numbers behind look, but let's take a look at the intrinsic value to get an idea whether or not the stock is over or undervalued. To do that, we have our 4 main models, the first being the Graham's revised valuation model, where we have a growth rate of 10%, which is pretty much in line with what analysts expect and also what the company sets as guidance for the EPS. So with that, I get an intrinsic value of 56. And if we jump into the cash flow for discounted cash flow model, you can see we also get a fair value around 56, and that is using a growth rate of 5%, something that I think is fairly okay if we look at how the evolution in the free cash flow have been going over the years. The next one is a dividend discount model, where I plugged in their dividends and I also get an intrinsic value of 56. The last one is multiples valuation, which is a bit harder to use, and it also says a stock price of $33, so I wouldn't pay too much attention to this one, I would say. If we jump into the summary here, you do have the 4 different models, and if we average those up, including the multiples valuation, even though I felt like it wasn't maybe the best fit here, it says a average intrinsic value of $48, with the current price being $36. There's also some discount to be had already, but if we take a look at the average discount, it's 23%. We apply a margin of safety of 23%, meaning that the acceptable buy price should be $38.50 or below, which we must say that we do have achieved already. This doesn't mean buy, this means go do more research, because I would say it's at a very attractive valuation right now. So if you like the company, then I think it's a pretty good time to get in. So let me know down in the comments if this is a company you are interested in, and if not, I'd love to hear as well. So thank you so much for watching this video, guys, and please don't forget to like and subscribe to the channel.